Veteran investor Warren Buffett is known to be one of the most respected voices on Wall Street. He knows how to build a fortune from nothing, thanks to his business skills and his analytical view of the markets. Although the businesses he owns are diverse, the ones I will highlight in this video might surprise you. These are high-profile multinational companies from which the Oracle of Omaha does not come off. Without any further delay, let's get into it. Which companies does Warren Buffett own? Many of Buffett's businesses share some attractive characteristics that can inform your own investing. Best known for his strict adherence to valorized investment and frugality, despite his immense wealth, most of his fortune is tied to Berkshire Hathaway and its subsidiaries. Berkshire Hathaway is among the most valuable companies in the world, largely thanks to the investments made over the years by Warren Buffett and his partner Charlie Munger. In its most recent annual report, Berkshire Hathaway listed 62 subsidiaries. For the purpose of this video, I will talk about a few that you should know about. Ready? Let's go! Among the Berkshire Hathaway subsidiaries, we have Geico. Founded in 1936, Geico is an American automobile insurance company headquartered in Chevy Chase, Maryland. In 1996, it became a wholly owned subsidiary of Berkshire Hathaway. Today, Geico is the second largest such insurer in the United States, providing coverage for more than 24 million vehicles. Geico is well known in popular culture for its creative advertising campaigns and has been a major proponent of the ride-sharing insurance industry. Geico was relatively small when Buffett bought the chunk of it that it didn't already own back in 1995. Today, with a workforce topping 43,000, it's the U.S.'s second largest auto insurer, and it offers other insurance coverage too for homes, rentals, flooding, and more. Next up, Duracell. Duracell was founded in 1924 by a partnership between businessman Philip Rogers Mallory and scientist Samuel Rubin. Originally, the company produced mercury batteries for the U.S. military. Duracell was later sold to Berkshire Hathaway by Procter & Gamble in 2014 in a $4.7 billion all-stock deal. The next Berkshire Hathaway subsidiary that we will look into is Helzberg Diamonds. Helzberg Diamonds was a family-owned jewelry retailer founded in 1914 by Morris Helzberg. Today, Helzberg Diamonds operates over 200 stores across the United States. Next is Kraft Heinz. The Kraft Heinz Company is the result of a merger between Kraft Foods and H.J. Heinz in 2015. The resulting company is now a food and beverage giant, amassing over $26 billion in annual global sales in 2020. It includes well-known brands such as Golden Circle, HP Sauce, Philadelphia Cream Cheese, Maxwell House, and Kool-Aid. Currently, Berkshire Hathaway owns a 26.6% stake in Kraft Heinz. Then we have American Express. American Express is a multinational financial corporation headquartered in New York. The company was founded more than 170 years ago by the merger of companies owned by Henry Wells, William G. Fargo, and John Warren Butterfield. Today, Berkshire Hathaway owns a significant stake in the company, worth 18%, providing products and services in the finance, insurance, and travel industries. American Express was ranked in 2020 as the 24th most valuable brand in the world. The company also scores well on employee satisfaction. Next on our list is BNSF. Due to consolidation, there are now only a few major railroad companies in the U.S., and BNSF, an acronym for Burlington Northern Santa Fe, is one of them. Its network features 32,500 route miles in 28 states and 3 Canadian provinces. It's the largest intermodal carrier in the U.S., carrying more than 5 million shipments in 2021. Tracing its roots back to 1849, it's the result of nearly 400 different railroad lines that merged or were acquired over 170 plus years. Next up, Home Services of America. If you've seen some homes for sale with a Berkshire Hathaway sign out front, you've seen Home Services of America in action. It encompasses businesses focused on brokerage, mortgage, franchising, title, escrow, insurance, and relocation services, and includes 46,000 real estate agents in more than 900 offices. And the last on this list is McLane. McLane is a key supply chain specialist in America, delivering groceries and food service offerings to convenience stores, mass merchants, drug stores, and chain restaurants covering more than 100,000 locations. It also has one of the largest private fleets of trucks. What is there to take home from these Buffett's businesses? How can the knowledge of these businesses help you? Well, think about why Buffett bought these companies. Clearly, he's building an empire, but he's also picky. He favors companies that are very well managed, aiming to keep management in place when he buys a company. He also loves to buy companies that generate a lot of cash, as he can can then deploy it to help some of his other businesses grow or to buy more companies. You too can be Buffett-like when investing. You can favor companies that generate lots of profits, some of which might be spent paying generous dividends to shareholders. You should always aim to favor great companies over merely good companies too. Great companies might have great management, great competitive advantages such as a strong brand, great financial health, and great growth prospects. Learn more about Buffett, and you might improve your investing results even more. You might even invest in Berkshire Hathaway itself to benefit from the growth of all the companies above. Next up, let's talk about 2 Warren Buffett rules you should never forget in investing. Warren Buffett's strategy for investing can be ideal for risk-averse investors. He has been a prolific investor for decades, soundly beating the markets on a consistent basis. What's noteworthy is that he hasn't generally done it by betting on big tech or emerging growth stocks in high-risk industries. His strategy centers around safety and not about taking oversized risks. There are 2 Buffett rules in particular that investors would do well to always keep in mind when buying stocks. Let's look at them both. The first rule is never lose money. The rule is so important that even his second rule is to not forget the first one. Not losing money in the stock market can seem impossible, especially in the current bear market. Even Buffett's business, Berkshire Hathaway, has lost money on its investments in the past and has even underperformed the S&P 500 index in some years. The nature of the stock market is that there will always be some risk. The key takeaway from this Buffett's rule is to not take unnecessary or excessive risks, and that the desire to avoid losing money should guide investors to making more calculated, strategic investment decisions, as opposed to jumping onto the latest meme stock. Buffett is a strong believer in the concept of a business analyst because, as he says, if you're not really sure you understand the business better than the market, don't play. As they say in poker, if you've been playing 30 minutes and you don't know who the cousin is you. On the other hand, when an investor acts as a business analyst, he is never obsessed with the short term. That is why it is easy to understand this phrase of Buffett: time is the ally of good businesses and the enemy of mediocre ones. To which he adds, if you don't want to own a stock for 10 years, don't even consider owning it for 10 minutes. And the way to measure whether you are really doing your job well is let it be the operating results of the companies and not the price of their shares that indicate whether your investments are successful. I especially like it when Buffett reminds us that emotions and expenses are our enemies. Try to be cautious when others are ambitious and ambitious when others are cautious. The second rule to strictly adhere to in investing, according to Buffett, is to stop digging. This leads to another great Buffett quote: the most important thing to do if you find yourself in a hole is to stop digging. In other words, if you've taken on too much stock risk and gotten yourself into a hole where maybe, for instance, your portfolio is deep in the red, the temptation may be to take on an even greater risk and swing for a 10-bagger investment that gets you out of the hole. But by doing so, you could end up with even greater losses. By minimizing losses to begin with, investors can avoid the temptation to take on excessive risks entirely. One industry where you can find many safer stocks is healthcare. Consider healthcare giant Bristol-Myers Squibb, a top-performing stock in 2022. Year to date, the stock is up an impressive 17%, while the S&P has declined by 21%. Bristol-Myers is a top drug maker that has solid fundamentals. Last year, the company had 3 products that generated more than $5 billion in revenue for the business: Revlimid, Eliquis, and Opdivo, and they all reported positive year-over-year growth of at least 6%. Another top healthcare stock that has performed reasonably well this year is Johnson & Johnson. Year to date, its shares are flat, but that would still satisfy Buffett's first and second investing rules by avoiding losses. These businesses are safe and are excellent examples of the types of companies to invest in if your priority is to avoid losing money. That concludes today's video. If you found the video helpful, please do consider giving us a thumbs up, and don't forget to share the video with your friends and family. See you next time.